Today I want to record a quick video discussing the concept of chasing returns. When I say chasing returns, what I'm referring to is that oftentimes a investment, whether it be an individual stock, a fund manager, an asset class, does really well for a certain period of time, and then investors start piling in thinking that because that trade did really well previously, it is going to continue doing really well. That is one of the most painful and often devastating things investors do, because what happens is, let's use Bitcoin as an example. All of a sudden it starts going up to 69,000. Investors start piling in because it was doing so well, and surely it's going to go up to $1 billion a coin, and then it comes crashing down. So they sell at the bottom, wash, rinse, repeat, and go into the next thing that did better while they were losing money. We don't want to do that. As investors, that is the last thing we want to do. And so I bring up this chart from JP Morgan just to point out, from a broad-based perspective, the asset classes that do the best in one year don't necessarily do the best in the next years. Right now, commodities is the most popular topic I'm hearing about, especially energy in particular. People think, okay, because of Russia and Ukraine, or what's going on in the US, or any other, you name the reason, they want to increase their exposure to energy. However, the reality is that oftentimes commodities, or any asset class in general, does not continue to outperform. So here we're looking at, in 2021, commodities was one of the top performers. In 2022, it was the best performing asset class. Can it persist into 2023? Absolutely. But more likely than not, what history has shown us is that when something has a lot of outperformance, it tends to go on to underperform. So we've seen that over time, commodities have actually been the worst performing asset class over the last, since 2008, underperforming cash. So again, we don't want to necessarily load up just because it has had a good track record of doing well over the last 24 months. Because again, what we'll see time and time again is assets that tend to do the worst or the best. In this case, let's look at REITs. 19, it was one of the best. 2020, one of the worst. 2021, the best. 2022, the worst. So again, staying the course, and as this chart talks about, this is looking at a 60-40 asset allocation. That's kind of besides the point of this video. But what JP Morgan's trying to point out is that having a diversification between stocks and bonds helps smooth your returns over time, lowering your volatility while increasing your returns. And that's the whole point of diversification and building out a portfolio. But the point I really wanted to make with this video is simply that the best performers from one period do not tend to be the best performers in the next. It can absolutely happen, but it's something that you shouldn't bank on. So when you're thinking about how do you want to allocate your portfolio, generally the best course of action is to typically do the opposite. You want to buy the things that have gone down, sell the things that have gone up, rebalance slowly but surely over time, but essentially stick to your long-term plan and not let your allocation be dictated by short-term events that are going to change from one day to the next. Anyway, if you have questions about this or anything else, please don't hesitate to ask.